Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to another edition of our weekly podcast, The Week That Was. Indian assets recovered despite higher volatility over the past week. Developed market equities continued their positive momentum as markets reacted positively to the less hawkish tone and central bank policy actions that were broadly in line with expectations. The US Fed raised rates by 25 basis points, lower than its previous hikes of 50 basis points, adding further that recent indicators point to modest growth in spending and production, while signaling that the battle with inflation is not yet over. European Central Bank raised policy rates by 50 basis points, noting that the risks to inflation had become more balanced with the energy price outlook significantly lower than expected in December, while also indicating that another 50 basis points rate hike in March could be in the offing. Bank of England also delivered its 10th consecutive hike, raising the policy rates by 50 basis points. While the bank still projects a technical recession, it now expects the contraction of the economy to be much shallower than projected in November. Back home, Indian equities eked out positive returns amid elevated volatility. The Nifty index staged a strong recovery on Friday after trending lower the previous three trading sessions, posting a gain of 1.5% over the week. Broader markets' performance was mixed as the Nifty mid-cap index was up 0.5%, while the small-cap index was up 1.9% for the week, respectively. Among sectors, FMCG, banks, and IT were the best performers with gains of over 2.8%, while energy and utilities were the worst performing sectors with cuts of over 6% for the week. The Indian fixed income market cheered the union budget for fiscal year 2024. Bond yields edged lower across the curve as the government pegged its market borrowing at 15.4 trillion, lower than the market expectations. For the week, the 10-year Indian government bond yield fell 11 basis points to 7.28%, while the 3-year and 5-year Indian government bond yields fell by 1 basis points and 10 basis points, respectively. The INR depreciated over the week amid high US bond yields, strengthening US dollar and foreign investor outflows. For the week, the INR fell 0.4% to close at 81.8 per dollar. Now moving the focus to the key takeaways from the union budget. India's union budget for the fiscal year 2024 surprised markets by taking significant steps to spur growth while maintaining fiscal prudence. The government announced measures to boost growth, which included 1. Higher capital expenditure for fiscal year 2024, which is pegged to increase 33% to a record US $123 billion, or 3.3% of India's GDP, with a focus on key infrastructure sectors such as railways and roads. The second important measure includes a boost to manufacturing with the doubling of allocation for manufacturing subsidies. This follows other long-term reforms such as corporate tax cuts, import duty changes, and the production-linked incentive schemes initiated in the past year as a part of the push to develop India as a global manufacturing hub. And the third measure, a cut in personal income taxes that could boost middle-class disposable income and spur domestic spending, aiding economic recovery. These measures were balanced by the government sticking to its fiscal consolidation path with a fiscal year 2024 budget deficit pegged at 5.9% of GDP versus 6.4% of GDP in fiscal year 2023. More importantly, the shift in the quality of spending towards capex and cuts in subsidies towards pre-pandemic levels are likely to support India's macro fundamentals. At this point, I'll take a pause and thank you as always for listening. If you find this podcast useful, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.